Joseph's been waiting a long time. Joseph asks, can you utilize your site for hedging credit spreads that would be purchased, say, out of the money for 2 months out, selling 2 weeks later? Well, yeah. I mean, you can search for bull put credit spreads, bear call credit spreads, or debit spreads, Joseph, based on any criteria you put in. This is my preferred settings and my preferred techniques using the weekly bull puts, but going 14 days out in time. Okay, looking for max returns of around, usually the top 5, those are high. Wow, charter's really high. The return is high from what I usually expect. I usually expect this, 14, 15, averages about 14% return for a 2-week trade. But you want to go further out in time? Absolutely. You say you want to go 2 months out, 60 days. Well, I could go to the straight expiration for April, or I could just tell the system to show me something that's 55 to 75 days out in time. Or my return is greater than 18, 19%, probability greater than 80%, however you want to do it. Okay, and then put in your fundamentals and technicals. Go ahead and submit the screen. Submit the search. I'm sorry. So the system's now going to find us which positions. Now, trick to this. Preferred status. Weekly, non-weekly. I always tell the system to only show me credit spreads that do not have an earnings date between now and expiration. Okay? What's the problem? The problem is most of the spreads that are there that match the criteria still have earnings coming out between now and this April expiration that I look for. Okay? Now, that's okay though. We'll take this position as an example, Joseph. Now what I could do is Twilio, 122.20, April 105 selling, buying the April 100 for a bull put, net credit of 81 or about a 20% return with an 81% probability. Now you're saying in 2 weeks you want to close, maybe if you get half of that. Okay, so what would I do here? Well, I'd probably add it to the portfolio in this case. This was the trade I was going to do. It matches the 2 months out that you wanted. You could tweak the criteria other ways for the return you want, minimum net credits you want, Joseph, and probability. Doesn't really matter, so let's just put it in new portfolio 1, call it 2-month spreads, okay? All right, so why am I going through the process, Joseph, of putting this into the portfolio? Well, the reason why is because I wanted to show you how to use some other features. So we get in here, I'm sorry, for a credit of, okay, this is about a 15% return. That's important to me. This probably isn't what you're doing, Joseph, but I wanted to show this as well. Why am I saying this is probably not what you're doing? Well, I was looking at 2-week out trades already that had 14, 16, and 20% returns. Why would I take a 2-month out trade that had a 15% return but look to close it 2 weeks earlier when I could just sell the 2-week out position that already has that return with an 85, 88% probability? Okay. Anyway, that's why I said you're probably doing something with a little higher return and a higher premium. You're looking for maybe a 25 or 30% return on this spread, but you're going to try to close it when it's at 10, 12, or 15. Okay, so for every position you put into the portfolio, Joseph, here's where I was going. We've got this alerts column. I can just click on view, and that will allow me to set different alerts. And for each option leg, I can set an alert for the option increase or decrease, percentage, monetary value, upper limit on the 2 options, upper limit on the stock as well, or the percent position change. And I want to be notified if my position can be closed for an increase of 50%, meaning a 50% profit, or let's say if the decrease hits 50%. Or, oh, I'm sorry. I thought there was a days to, it's not. It's days to, I'm sorry. I was reversing it in my head. It's days to earnings. I apologize. I'm going to say you could put in an alert here to close it in 14 days, but that doesn't work. I thought it was days until expiration. So if we open it with about 60 days out, we could say close it or alert me when I'm 45 days to expiration if you wanted to close it in 2 weeks. Okay, but you could set the alert when position change. Oh, there it is. I'm sorry, less than 45 days away. That'd be about two weeks out, right? Yeah. Yeah. Okay, so that'd be 2 weeks in because I was looking about 60 days. Now I just save alerts, and the system will notify me when an alert is triggered, Joseph. Okay, so that's one way to do it. But yes, it can help you with that. You can find the positions that are 60, 70 days out in time that match that criteria you're looking for with your returns, and you could set alerts in there as well. Okay? All right. Okay, John asked the question is a little bit more in depth. The question up front is simple to answer, John. But based on what our email back and forth we had today regarding your Bull Call Debit Spreads, it's a little bit tougher to answer. Two simple things. The easiest thing to do, once you've created your search, don't do this first, John, but once you've put in some of your criteria you want in a strategy, Bull Call Debits, Bull Put Credits, what have you, once you've put in your search and you've narrowed your results down to under 100, under 200, maybe even under 400 results, just click that one result per security. What that does is it goes through each individual iteration of, let's say, 500 results. Let's do that real quick. Let's try to see what we can do here. I'm going to go to Bull Call Debit and go into the search. I'm going to see something. This has come up before. What John was asking me about earlier was setting positions. I can't remember your time frame, John. It's not important. We won't worry about that right now. But looking for Bull Call Debit spreads that are technically out of the money, trying to have a more of a 1-to-1 to 2-to-1 risk-reward ratio. Rather than setting up an in-the-money Bull Call Debit spread with a higher probability, it still carries a 7 or 8-to-1 risk-reward ratio. Go out of the money for a lower cost, lower probability of receiving the maximum return, only about 45-50% or so, but having a 1-to-1 risk-reward ratio, paying $1 to potentially make $1 back if you are right and you make the maximum return. A very popular strategy has been used, especially over the last 4 years and the last 4 months with the market conditions that we've had. So let's go long term. Let's just go to March on this one. 40, that's not even long. April would be good, 2 months out. But let's just stick with March. Now we're talking about a Bull Call Debit spread where I'm going to sell a call and buy a lower strike call to pay a debit in this case. Okay, so it's going to be entered as a debit, a cost, and the idea is if the stock's trading above both strikes, I get the difference between the strikes back. Rather than a credit spread where I take in the credit up front, here I'm paying the debit with the hope to get that back. But something with a good probability that's in the money where both calls are below the current stock price like we saw with some of our bull puts, the 70, 75, 80% probability, this might be a debit on a 5-point spread of 420 to make 80 cents. So we're talking about a, sort of 7-to-1, 8-to-1 risk-reward ratio in that case. That's a bit low. Now it's a 5-to-1. If I said 80 cents, it was probably, 440 to 60. Okay, so we're 7-to-1, 8-to-1 risk-reward ratio. But if the stock is here and I sell at or slightly out of the money and buy one strike in the money and I'm on a 5-point spread, my cost might be 260, 270. So I'm looking to make 230 maximum profit off a 270 price, closer to 1-to-1. Okay, so how do we do that? Well, my short option wants to be one strike out of the money, so the in the money, out of the money range focuses just on the pivot option, the short option. So I'm going to tell the system to go 0 to 2 out in time. I don't have a long option screen here for the spreads as far as in the money or out of the money, but I do have a delta. So if I wanted to go slightly in the money, I might just go 0.55 to 0.60. So what I'm saying is I want to go kind of 1.5 strikes in the money on the long option only. The delta is doing that for me. In the short option, I'm limiting it to 2 strikes out. This is a bullish strategy. I'm still doing Bull Call Debit spreads, so let's put some basics in. All right, I want a stock with good earnings per share growth. I want to avoid anything that has earnings between now and expiration. Probably want just mid to large cap stocks or small cap surprises. Technicals, hey, let's get a stock trading above the 50-day or 20-day moving average. I'm going to keep it at 20. Okay, and I could use MACD as well. I want to have to be at least the MACD have a positive cross over the signal line by at least 1 day, and hey, why not? Let's force it. Let's force the MACD to be positive. Not something I normally do, but we'll do in this case. And that's it. What have I not put in? Anything related to the total net debit, strike difference, anything else, volume. Okay, let's see what we've got. Okay. Shoot. Should have put volume in. Let me put at least open interest, and I saw some errors right away, and I want an option bid. Yep, option bid of greater than 0.1. Okay, this is probably going to limit it down even more. Okay, so 68 total results with some reasonable premium. Too far out of the money. Okay, that's fine. I'm going to take it down to 1. 0 to 1 strike out of the money instead of 0 to 2. I didn't like some of those positions real quick. Excuse me, Tesla is good. 748.07. Not saying this is a good trade. I'm saying that those are the numbers I want. 750 to 730. ULs. But see, oh, here's 4 more Teslas. 750, 740. 748, 750, 745. Now here's where it gets tricky. The easiest thing, John, is to just click the button there for 1 result per security. Okay? What can't I promise you? What showed up, what it limited to is however you were sorting it. It kept the one that had the best return because that's how you're sorting the result. Not the best probability, but the best return based on how you're sorting it. This might not be the one that you want because it's 20 points apart. Yes, your short option is still out of the money. Yes, this still has the delta of 0.55 to 62, but you say, oh, I want the 750, 745. I don't want the 730. It's too far apart. Okay. Only other way you can do that is to actually set your strike difference. Let's set the strike difference to be less than or equal to 5. That should give me the 750, 745 Tesla. Yep, there it is. Okay. 7570 on Dolby Laboratories. You know, and see, this is a hard search, by the way. This is a hard search too. I had a customer 6 months ago who I worked with him for about 3 months straight to kind of get what you're doing. And I understand what you're doing. Right? Well, the other customer's idea, John, I don't know if this is what you were doing. The other customer's idea was, I want to see every possible stock combination of a bull call debit spread that's 30 to 45 days out in time where I'm selling 1 strike above the current stock price and 1 price below. And I got him set up to kind of that, but I had to pull some teeth, not pull teeth, but I had to go over it with him because we needed more information. Right? I needed to know, do you really you want to look for bullish stocks, don't you? You don't just want everything, including inverse ETFs that would go counter market. You just want bullish stocks. You don't want inverse ETFs. You don't want indexes. I said, oh yeah, that's all I want. Okay. You don't want anything with earnings. Oh yeah, I don't want anything around earnings. Great, fantastic. Narrowed it down, whittling it down. But then, of course, there's still a problem with some stocks that just offer strike prices that, yeah, this is correct. TXT, $50.75. What's 1 strike out of the money? The 55. Because it doesn't have a 51, 52, 52 and a half, 53. It has 5 points. So the 55 is the one out of the money. The 50's in the money. And you say, oh no, what I wanted to see here is I want to see the 47 and a half and the 52 and a half. Well, I'm sorry, it doesn't have that. Okay, so based on where the stock is, there's going to be some fluctuations. Here it's correct. TAL 5601. 1 strikeout is the 60. Doesn't have 2.5 point spreads. I traded this last year as a married put. It's got 5 point spread. So the correct spread is 55 to 60. That's correct. 1 strike in, 1 strike out. There is no 57 and a half. I take a $56 stock with this kind of structure, John, absolutely. I think the most immediate thing is selling the 57 and a half and buying the 55. It doesn't have 2.5 point strikes. It only has 5 point strikes. So you kind of have to get where you are. I mean, this one's perfect too. If you look at New York Times, 37.42, selling the 38, buying the 37. That is pinpoint on to 1 strike in the money and 1 strike out of the money. And that is this proper spread that would come up. We don't see any others at 38.36 or 38.35 or 39.37 because we told it just to use 1 strike per security. But in the case of what we were talking about a little bit earlier, John, there's some other caveats you might want to put in there based on the structure you're looking for, and I really think that strike difference that we used on the spread page there, the less than or equal to 5, is going to get you to results with the one result per security to find what you're looking for. That's my guess, my assumption, but let me know how that works out. All right. Speaking of Darrell, 2 more quick questions, I believe. Darrell says, bull and bear call put vertical that is profitable. How best to protect the profits if you don't want to get out? Get out. That's the best way, Darrell. I'm sorry. You can't. You could roll the position maybe, but look, here's the key. You're asking me if I'm in a bull put credit spread that's profitable right now. I don't know, bull put spread a week ago, say on a stock, it moved up. I can close it for 50% profit right now, but I want to stay in it to get the 100. How do I protect it? What do you need to protect the bull put spread from? A decline. What's going to give you the best hedge or protection on a decline? Buying a put. What did that just do to your bull put credit spread? It turned it into a ratio put spread, a completely different strategy. You can't use the idea of hedging and insurance that you use for a stock position on a leveraged spread, okay, because you change the entire dynamic. Did you protect it against a loss, and could you have a profit if the stock fell? Yes, but now you've totally changed your strategy. You've totally changed the dynamic. Let's see here. Well, we'll try this very quickly for you, Darrell. My suggestion is close it. All right, I don't like to close spreads at a 50% profit or 60. If I hit an 80% profit, I might close my spread early. Really, since I'm doing shorter term spreads, I want to keep it longer to expiration. So let's go back a week, shall we? And okay, I'm sorry. Okay, I'm just waiting for that. Okay, there's that one. Okay, so sorry. Well, you can use that one, but that's probably too much. I think Norfolk Southern. Let's check Norfolk Southern real quick. I just want to do an analyze. So what I'm looking at, Darrell, here is if I had opened one of the bull puts that matched the bull put weekly screen last Friday, the 31st, the Tesla position would have been profitable as we saw, but of course it would have been too profitable. You'd be at about a 90% profit, and I'd tell you just to probably close that anyway because we still have another week to expiration because they're not expiring today. They'd be out in 7 days. 20.7. I was hoping for 50. It's not quite at 50 yet. Stock hasn't moved that much. BlackRock? That go the right direction? Let me just take a quick look, and then we'll use Tesla if this doesn't do what I want. So what Darrell asks is, would selling a higher strike call or lower strike put give a reasonable hedge? No, because now you're increasing your risk, right? I have a bull put credit spread that's successful. It moved up. It's maybe at 30, 40% profit. This one's only at 16.5, so we're going to use Tesla. Sorry, guys. Okay. Should have just done it from the beginning. But here's the idea. If I've got a bull put credit spread, Darrell, and I sell a lower strike put, what do I have to do? I have to put up the cash as a naked put. I do a further out of the money, a lower bull put credit spread. Well, I'm only getting 5 or 10 cents. That doesn't hedge the loss against the position I have. It only hedges it by 5 cents. Okay. Oh, this is even less. I thought this would have been much higher at this point. Okay. All right. In any case, Norfolk Southern, 195 net credit. 195, 192 and a half, 45-cent net credit. NSC. Okay. NSC. Let's fake a trade here, Darrell. Bull put credit spread. $192.5 put bought, $192.5 put sold. The contract, let's put 5 apiece. The math isn't going to matter. We're looking at the return here. And the price. I didn't catch the prices. We're going to fake. Oh, sorry, wrong view. 95 to 140. Okay, 55 to 90. So 30. 45-cent net credit. We'll just use $1.55. How about that? Actually, no. We're going to use $1.35. Okay. Because I'm going to show us having a larger profit, Darrell. That's what I was looking to do. All right, so 65-cent net credit on this fake trade, which was kind of real, that matched the criteria. Right. It's not as high as I thought it was. What is... Sorry, folks. 20 and 23. So I could close it for a 3-point debit. Yeah, that's pretty much near what I'd expect it to be. Okay. I was going to go to position analysis, but let's just go here. Did I do this wrong? Ah, I put the prices in wrong. That's why it was confusing to me. I'm sorry, folks. I got the sell and the buy right. I put in the wrong prices. My apologies, sincerely. Okay, so 65-cent net credit, much better. 35.1% return. We could close it right now for only a debit of about 5 or 10 cents. So we've made about 70, 85% of the portfolio. Real wrong because I put in the wrong prices. How do I hedge this now? What's my risk? 925. Should have just used 1. I'm really sorry. Let's just use 1 to keep the math simple, Darrell. Okay, so again, 65 cents direct in, risk of 5 points. No, 2.5 points, so risk of 185. What's the goal here to hedge it? Cancel this 185. Okay, so the stock's at 210. What happens now for the same expiration if I buy? Remember, we got 65 cents. What if I buy half of that? About 30, 35 cents by buying another put at the higher strike at 200. What does that do? Puts me in sort of a weird ratio back spread. I have no risk, guaranteed to make 32, but that's on the way up. That's half the expected profit I wanted. Would this still match your trading goals? Now, if you start off with a 30% return, it probably would. And if it falls, yeah, it shows you an infinite max profit almost, because you've got 2 puts against 1. Okay. You could close it out right now. Remember, if we liquidate right now, we're almost at the full 37% profit. You're cutting that by more than half, that if it keeps going up, you still make it. Let's take a look at let me edit this position so we've got the right numbers there. It looked like it was 3 cents to close it. My numbers were all fouled up because I put in the wrong ones. We bought that for 35 and we sold this for 1 for a 65-cent net credit. Fake numbers. All right. Whew, thank you. 96.2%. 313. Now that's not a 96% profit, but it's 96% of a 35% profit. So why would you stay in it? All right, so this hedge that we're talking about, Darrell, what did you do? You took away from the cost basis, you added a put option. You could make extreme amount of money if it falls, but you'd be better off liquidating right now and making 32, 33% instead of cutting it to only 14%. That profit is up here. It's a negative max risk, meaning that that's the most you could make now is $33. Why not just take the 60 and liquidate right now? Okay? Don't overthink it. All right, and this is what I meant. If I had bought the stock at 195 and now it was trading up at 210, I'd want to hedge that with a put. But this is a leveraged spread. It's not a stock. The minute you add another option to it, you change the entire dynamic of the position. I would just close this. Take that 96% profit. Why risk making less if it's not part of your trading plan when you can make almost 100% right now of what you expect it to make? This is an extreme example, but again, that's what we're talking about there. Now, some investors say, oh, well, if you've only got 14 days, 7 days left to expiration, you've been in it for this long, the stock's at 210, why not just enhance it with a iron condor, go further out in time? Well, see, now there's no premium. I could do the 215, 217 and a half and get maybe another 40 cents or so. Is this a hedge? Well, some people call it a hedge. But at the same time, what have I done now? I've given myself 2 ways to lose. The only premium that's worthwhile is 5 points away from the stock in the direction it has been going. I potentially doubled my return. Yes, not quite doubled, but yeah, we did increase the return, we increased the percentage. But your broker's probably going to charge you another margin requirement here because they won't read this as an iron condor. They'll read it as a bull put and as a separate bear call. Okay? This is not necessarily advisable because if the stock continues to go up, what could have been the full gain on the bull put credit spread could now end up being a loss on the bear call side. That's not what you really want. See, that's the trick with credit spreads there. That's what I'm trying to impress upon you the most, is that common things that you think would be a hedge. Oh, I'm in a bull put spread. I've got a gain. How do I lock in the gain? Let me just buy a put. You've changed the entire dynamic because it's not a stock. Those simple rules don't apply to the spread or a diagonal spread. It changes the dynamic because of the structure of the trade. You're already in a leverage trade. Could you roll this up and have a no-risk trade? Maybe, but you'd have to roll up and out. What do I mean by that? You saw I could close this and make almost 96% of what I expected to make. I'm going to take in 60 cents. So what's that like? That would almost be like opening another trade, another bull put, say out here, if I got a 50-cent net credit, but I count that 60 cents that I just made into it. So I'm actually making a 110 net credit against a 2.5 spread. I'm only at a 1-to-1 risk-reward ratio. Yeah, but it could still come back to a loss, couldn't it? If it falls down now below 205. So let's think about that. Let me clear this out. We took 65 cents in. It's going to cost me 5 cents to close it. So I'm keeping 60 cents of profit, the original bull put. We're keeping 60 cents. I close it. I decide now to do the 205, 202.50 now that the stock's up at 210 for another week out in time. We're rolling up. Okay? So this is going to give me a net credit of what, 40 cents? Oh, right at 50. But I'm going to count my 60 cents in from the close. So this is 278 I'm taking in with 168. Now it's my max return, 110. Sorry, it didn't load properly before I scrolled. 110, right, is your new profit on this position, but it could still become a loss. Not true, the next bull put spread you enter could become a loss anyway, but you see what I'm saying is that, yes, you doubled this. You've still got the margin involved. You've rolled it up and out, and you've got more of a 1-to-1 risk-reward ratio, but if NSC in the next 7 days, 14 days pulls back and starts to fall down, now you could have a loss. Absolutely. I would just take the 80 to 90% profit there is on that position as well. Okay? So that's sort of the tricky part with doing these extra moves and trying to get too fancy with managing these spreads in this fashion, is because the common rules don't necessarily work the same way on a leverage put, calendar spread, or leverage call spread as they do for just a long stock or even a long call position. Hey, if I have a long call and it's moved up and I'm sitting on a 50% gain, I'll buy a put to create a strangle to lock that in. Absolutely. Not something I'd really do in a bull put credit spread or in a bear call credit spread in that case. Okay, I'm not sure I understand this question here. I understand it, Joseph, but I think I read it wrong the first time. Would you think IBM would be a good buy on a credit spread for, say, an out-of-the-money 2-month out with a $5 spread of the April put and call? I don't know if you're talking about a bull put credit spread or a bear call credit spread. I don't know. Here's the 3 things I can't give you that kind of direct advice, Joseph. I can't do that. I'm not an advisor. I can't give you direct advice on a singular position as far as, do you think it's a good spread? Would you do this? Would you do that? What you've heard me say before, and what some of them have heard me say before and some of them do. First things first, make sure there's no earnings coming out if I'm planning on doing a credit spread. You said call and put. Let me go back. When I say credit spread, I mean one of the 4 vertical spreads. That's a credit spread to me by definition. Bear call credit, bull put credit, bull call debit, bear put debit. You might mean the same thing, Joseph. I get that. But this other subtle comment you had here says 2-month out with a $5 spread of the April put and call. Now, I'm not sure if you're talking about an iron condor, combining a bear call credit spread and a bull put credit spread, or if you're talking about a short strangle, or short straddle, which I never trade. Okay? So, all right, you did come back and you said bull put credit spread. Okay. So, 3 things I can tell you. Number 1, make sure the trend is going in the right direction. I'm not going to do that for you. You've got to make sure that you feel comfortable with stocks in that position. Number 2, general rule of selling bull put credit spreads, bear call credit spreads, selling naked options. It's better to sell shorter term and increase your annualized return than it is to sit in a high risk, maybe 8-to-1, 9-to-1 credit spread that's 2 to 3 months out in time, because a lot can happen in 2 to 3 months. Your entire perception of the market can change in 30 days. Heck, it can change in 10 days. Okay? So that might be too far out. Make sure I have no earnings between now and that expiration. Make sure that the stock is going in the trend that I want. I'd probably look shorter term. And, April's the 70-out series, more results. I'd look for a general probability, but I don't know what you're looking for. What do I mean by that? IBM's at 153. Your goal might be to try to get into IBM at a lower price through a naked put position, but you don't want the risk, so you're going to take a 5-point spread of selling the 150, buying the 145, which only has a 61% probability. And you figure if it falls below 150, great, I keep this $1.42, my cost basis is 148. I don't do it that way, so I can't tell you if that's a good idea or bad idea. Is it a good idea to you? What's the risk to you? See no harm in doing a 5-point spread, of course, naturally, but it's got to match your goals. What probability do you want? Range out of the money do you want? Do you have a long-term trading plan for this? And if so, you might be better off going month by month by month, or every 14 or every 20 days instead of jumping right now and going 70 days out on this position, depending on what your expectations are. Okay? So that's, what I can't answer for you, Joseph, is what are your goals? Why do you think this initially isn't a good trade? What is your trading plan for this portion of your portfolio to use bull puts or bear calls? And that would determine for you, I think, more along the lines, is this a good approach or a bad approach? And I'm not saying it's a bad approach. I just don't know what your approach is. That's more personal. That's what I can't do. That's more on the advising side. You've heard me say in discussions, I like to be closer in, 20 to 14 days out in time with these credit spreads, 80-85% probability. Spread difference comes down to what is my goals for the target return and how much money do I want to put up in the position. But all of that still has to match. Is the stock going in the direction I want? Does it not have earnings between now and expiration? Am I comfortable with the potential to manage this position long term or not have to manage it in general? That's the best way I can answer it. Yeah, without going any further. See, so let me put you this way. This is 70 days out in time. And I know it's not your target. This is why I can't answer it. I know it's not your target, but you've heard me just kind of spew some criteria, meaning that what am I looking for in general? 80 to 85% probability. Right here, I'm at the 140 for April. Okay? The 145's got a 74.5% probability. The 150's at a 61.2%. So I've got 384s here, what I'm starting with, and I've got a 12% return, a 9% return, a 7.5. How are they different returns? The different strikes. Okay, so I'm getting a higher net credit each time, but the strikes are I'm getting an increase of 30 cents here in the net credit from the 140, 135 to the 140, 130 10-point spread, but 30 cents to increase by 10-point margin requirement. So the risk goes down by about 3%, and then another 2% when you go to the 15-point spread. But you get a credit of $1.05, double almost what I'm getting on this one. So that's where that question to you is. Which one matches your goals? Earlier, we were talking on the weekly bull puts. I said I look for this 80-85% probability, and I want that 12, 13, 14% return. Right away, my eyes are drawn to this, but that's 70 days to make 12%. "14 days out, 148, 146 strike. Yes, it's closer. It's only 5 points away. No earnings between now and expiration. Net credit of only 25 cents on a 2-point spread. But that's a 14% return with an 83% probability for 14 days, not 70. So this is a different balance. This is why I typically don't go 70 days out in time, because I can get the targets I want with the shorter term trades and not be in it for 70 days when the market as a whole, excuse me, might change. That's me personally. But again, I'm not doing this to try to get into IBM in the form of a bull put spread, meaning I want to get maybe assigned on that put because 150 or 145 is my target price to buy IBM, but I want to have that other put in place just in case it really tanks against me. That's not my goal. My goal is to just use this to generate income and have it expire on a shorter term basis. We don't have the same trading plans. We don't have the same approach. So I can't go that far. This is just based on what we've taught and what we've seen and what we've discussed for the weekly bull puts, and using the weekly bull puts, what has worked and hasn't worked for us. That's why I'm looking at this approach and why I keep using it. But that farther term out, going 2 months out or 3 months out, I think is a better idea for those at the slightly out of the money bull call debit spreads that John and I were discussing a few moments ago. Okay, and Joseph says, so not knowing all that you offer, do you have webinars on income generation? Yeah. You're not looking at that now, are you? I apologize, Joseph. Hold on one second. There you go. Okay, so if you go to our free webinars page, this is a public page, powerop.com/webinars.asp. Some of the videos may be hidden if you are not a current trial member or subscriber, but a lot of the webinars that we offer here are free. Okay, so I just sent the link to everyone. It's just poweropt.com/webinars.asp. And scroll down and click on Options, Strategies, 4 sections: Tools, Strategies, Concepts, and some of our requested topics. Topic 1, should I close my spread at 50% profit? 4 questions on iron condors. But I'm going to go down a little bit further here. So what are the income generators? Well, you've got covered calls, naked puts, bull put credit spreads, bear calls, iron condors, diagonal calendar spreads. And so if you just scroll down through this list here, you eventually get to credit spreads beyond the basics, part 1 and part 2. The basics of credit spreads, income. 8 ways to manage a bull put spread. How to be successful with spread trades. Calendar spread criteria and calendar spread basics. Managing covered call positions for generating income. Managing your bear call credit spread. Here's one on long options. That's buying. Naked puts and managing your naked put positions. Vertical spreads, a hands-on look, protective options strategies, discussions on collars. So there's a lot of free education that is available there for you, Joseph, directly on the public webinars page, poweropt.com/webinars.asp. If you have the time, you can scroll through a lot of the requested topics. A lot of these are combinations, just like today, of our Friday discussions. There are different topics discussed, finding overvalued and undervalued spread, scrolling through all of these rolling covered calls, managing synthetic positions. Let's see, I'm looking for income ones. It's not labeled that way. That's a little bit hard to do, but right in that option strategy section, it's got you covered. There's a lot of discussion there on income generation and the income strategies. Now, if I say income method, that's related entirely to the radioactive trading principles from radioactivetrading.com as discussed in the blueprint, the married put structure we set up initially, and then do that as well, the 12 different income methods we use off that. That's using a married put structure for protection and going forward. Okay? All right, so that's what I wanted to answer there for Joseph. Now, back to us here. I just wanted to remind everyone that today's material is my thoughts on your questions designed for educational purposes, increasing investing performance and options knowledge. Any stocks or options discussed in today's presentation should not be taken as direct trading suggestions. I'm not going to, as we saw with Joseph, I'm not going to be able to tell him, is it a good way to trade IBM? Am I going to trade IBM? I'm not trading Tesla. I'm not opening, I do have the index position, but I'm not necessarily opening the Etsy position or the eBay position. Fusion subscribers will find that out if I open married puts next week. Options do involve risk and may not be suitable for all investors. If you like what you saw today with some of our tools, the search capability we talked about with John for a little bit there, and looking at some of the other positions for straddles with Terry early on, remember you can take a test of that for 14 days. Just enter your name and email address, full access to Power Options for 14 days. After that, this monthly subscription fee starts at $45 per month. Most popular services are 15 to 20 minute delayed data at $65 per month, but you can also go up to real-time and historical as well. In addition to the webinars page I just mentioned there for access to a lot of education, free education and more on the strategies, the tools, and more. You can also check out our blog, blog.powerop.com, and a lot of our videos are also always posted on YouTube. You can check them out at youtube.com/PowerOptions. Just search PowerOptions on YouTube, as we all do. All right. Well, ladies and gentlemen, if you think of any questions over the weekend or later on, remember, send me an email at any time to support@powerop.com or support@radioactivetrading.com. You can also call us during market hours at 302-992-7971. And of course, remember, trial members and subscribers can schedule a coaching session at any time. That's a free 35 to 45-minute phone conversation with myself or Ernie. We'll answer any questions you have, just kind of like I answered all of your questions today. That's essentially what a coaching session is as well. And you can have as many as you want as a trial member or subscriber. Well, Sam, John, Terry, Jim, Darrell, everyone else there as well. Fernando, of course. Great to see you all here today. It's great to see everyone. Thank you all for your questions. I hope you have a fantastic weekend. Sam says, thank you so much. Very kind of you to teach us and making us experts in trading, I believe you said. Enjoy the week, everyone, and enjoy the loved ones. That's from Sam, and I'll say the same thing. Take care, everyone. Have a fantastic weekend. We will see you soon. Good night.